Right now, the world's biggest technology companies are spending, literally tens of billions of dollars constructing artificial intelligence data centers.
Oh, absolutely. It's a massive, massive capital cycle.
Yeah, and they're pouring money into specialized silicon, cooling infrastructure, real estate.
Yeah.
But behind closed doors, the engineering teams building these facilities are actually terrified of one very specific, very physical reality.
Melting their own hardware right to the ground.
Exactly. The compute density required for modern AI workloads generates a volume of thermal friction that borders on, well, the catastrophic.
Right, because if the electrical current feeding these systems fluctuates or degrades even a tiny bit, the equipment doesn't just underperform. It incinerates.
It literally burns up.
Yeah.
So today, we are looking at the exact company whose sole operational purpose is to stop that from happening.
Which really frames the financial reality perfectly, I think.
Yeah.
Because the narrative around artificial intelligence and by extension semiconductor manufacturing, it focuses almost entirely on processing capabilities, right?
Software models, logic gates, parameters, all that stuff.
Exactly. But you cannot process an algorithm without power, and not just raw electricity from a local grid, but highly engineered, mathematically flawless power delivery.
Right.
We are talking about power conversion technology that operates with such precision that it dictates whether a microchip functions or just ends up as, silicon waste.
Which brings us to the core of today's deep dive. Welcome in. If you are joining us today, you are looking for that translation layer between complex engineering and corporate finance.
Yep.
We are adopting our special talk tickers format for this analysis.
Which is my favorite format, honestly.
Same here. That means we're prioritizing the data, we're stripping out the corporate relations gloss, and we're taking a definitive, opinionated stance on the financials.
Just giving you the actionable takeaways.
Right. So we have the Q2 2026 earnings call transcript from Advanced Energy Industries. That's ticker symbol AEIS.
AEIS, yep.
And we are going to dissect the operational metrics provided by their executive team, analyze the end market demand driving those metrics, evaluate their forward guidance, and, distill all of it into an actionable thesis for your portfolio.
So we've got 4 main pillars today.
Okay.
First, the headline numbers. Second, the story behind those numbers. Third, management guidance. And finally, the bottom line.
Perfect. Let's jump straight into section 1, the headline numbers. Because you can't really know where a company is going without knowing exactly where it stands today, right?
Right. And the place to begin is always the top of the income statement.
Always.
You have to establish the baseline of current operational health before you can project any sort of future market share. So Advanced Energy posted $574 million in revenue for the second quarter.
Wow.
Yeah, that represents a 30% growth rate year over year, which, by the way, just sailed past the high end of their own internal guidance.
Okay, wait. 30% top-line growth is a highly anomalous number for a company that manufactures physical hardware.
It really is.
We are not talking about a software as a service firm here, where the cost of goods sold on a new customer is basically zero.
Right. They aren't just sending out download links.
Exactly. When a hardware company scales revenue by 30%, they typically have to scale their variable costs right alongside it.
Yeah, you have to buy more raw materials, run more factory shifts, pay for logistics, all of that.
And so the margin profile usually stays flat, or it even compresses under the weight of that scaling.
But the earnings per share here, they just diverge entirely from that standard physical manufacturing model.
Let's hit the EPS numbers.
So non-GAAP EPS came in at $2.74 for the quarter.
Okay.
And in Q2 of the previous year, that number was just $1.50.
Wait, really? $1.50 to 2.74?
Yep. So while revenue expanded by 30%, their earnings per share grew by an incredible 83%.
That is massive. That delta between revenue growth and earnings growth is, it's the clearest signal of operating leverage you can find on a balance sheet.
Oh, totally.
It's like, think of a restaurant, right? It's like a restaurant that didn't just get 30% more customers, but somehow figured out how to make almost double the profit off every single meal they serve.
That's a perfect analogy. And we need to contextualize how they achieved that leverage.
Yeah, how did they pull that off?
Well, as you said, in software, operating leverage comes from writing code once and selling it infinitely. In hardware, achieving an 83% earnings jump on a 30% revenue increase requires a fundamental shift in unit economics.
Right.
Their non-GAAP gross margin expanded by 380 basis points year over year, landing at 41.9%.
Almost 42% gross margin on physical hardware.
Yeah. Now, we do need to account for a specific regulatory event here, just to be completely fair to the data.
Right, the tariff thing.
Yeah, the transcript details a one-time refund under the International Emergency Economic Powers Act, or IEEPA.
Okay.
This tariff refund contributed roughly 4 cents to their EPS.
So a slight structural anomaly, sure. But even factoring that out, I mean, the underlying operations hold up.
Oh, absolutely.
If you strip out the IEPA benefit, the base gross margin is 40.7%. That still beats expectations.
By a wide margin, yeah.
So what's driving it? The CFO attributed this base margin expansion to, quote, manufacturing efficiencies and a richer product mix.
Right.
What is richer product mix in plain English?
So richer product mix is basically just corporate phrasing for selling a higher volume of top-tier, newly engineered equipment rather than their older legacy systems.
Okay, got it.
And it indicates serious pricing power. When an engineering firm transitions its customer base to next-generation platforms, all the R&D costs have already been sunk.
Right. They already paid the engineers to design it.
Exactly. So the new platforms command a premium price because they solve higher order thermal or power density equations for the customer. And that premium flows almost entirely through to the operating income.
And we see that reflected directly, right? I mean, operating income hit a record $125 million.
Yep, with operating margins expanding 730 basis points to 21.9%.
Breaking the 20% threshold on operating margins is huge for this specific industry.
It's a massive milestone.
It translates to highly liquid operations. I mean, they reported $86 million in operating cash flow just for the quarter.
And their total cash and equivalents pile now sits at a war chest of $1.4 billion.
Which is insane. But the accumulation of that cash wasn't purely organic from quarterly sales, was it?
No, not entirely. It was the result of a very specific debt maneuver they pulled off in May.
Okay, walk us through that.
They executed a $1.15 billion convertible note offering. And the crucial detail here, the really fascinating part, is the coupon rate.
Right.
It is 0%.
0%. A 0% coupon in the current macroeconomic rate environment.
I know, it sounds fake.
It's a fascinating piece of financial engineering. I mean, institutional investors are not providing Advanced Energy with over $1 billion for free out of the goodness of their hearts.
No, definitely not.
So what's the catch?
Well, a convertible note means the debt holders have the right to convert their bonds into shares of AEI stock at a predetermined strike price before the note matures in 2031.
Okay, so they are forfeiting immediate yield like the regular interest payments they would get on a standard corporate bond because they're calculating that the equity upside of Advanced Energy over the next 5 years will vastly outperform whatever yield they could get elsewhere.
Exactly. It's essentially a synthetic equity play by the debt markets. They're betting big on the stock price going up.
And Advanced Energy's Treasury Department utilized this 0% capital immediately, right?
Oh yeah, they didn't just sit on it. They took $438 million of it and redeemed older convertible notes that carried a 2.5% interest rate.
Oh, wow.
Yeah, and those older notes were due to mature much sooner in 2028. Plus, they announced they'll clear out the remaining $136 million of those older notes by September.
So they essentially swap expensive near-term debt for free long-term debt.
Easy.
That is a masterclass in balance sheet optimization. They pushed their debt maturity cliff out by 3 whole years, eliminated the 2.5% interest drag on their cash flow, and stockpiled capital.
It's brilliant. And the executive team explicitly noted that this positions them for inorganic growth.
Meaning acquisitions.
Right. With $1.4 billion on hand and no interest obligations on that new debt, they are perfectly positioned to acquire complementary technology firms or even competitors who might be struggling with a higher cost of capital.
Well, organic growth remains the primary driver, right? Which transitions us into section 2. The story behind the numbers.
Yes. Let's break down exactly which sector are buying what AIs is selling.
Because numbers on a spreadsheet are just the symptoms. Right. End market demand is the actual cost.
Exactly. And the semiconductor segment is the foundation of their current revenue base. They brought in $278 million just in that segment for the quarter.
That is a juggernaut.
Yeah. That is a 33% increase year over year and a 27% increase sequentially from Q1.
Wait, 27% sequentially, like quarter over quarter.
Yep.
A 27% sequential jump in a 90-day period indicates a sudden aggressive acceleration in capital expenditures by their customers.
It's massive. And the management team attributes this to wafer fabrication equipment demand, specifically for leading-edge memory and logic.
Okay, but the phrase the CEO used on the call was increasing etch and deposition intensity.
Right.
As an expert, we need you to translate the physics of that statement. What does that actually mean?
Sure. So to understand the demand for AES power systems, you have to understand atomic layer deposition, or ALD.
ALD, okay.
When semiconductor foundries manufacture the latest logic chips or high-density memory, they are operating at geometries measured in nanometers.
Like unimaginably small.
Right. They are no longer just printing flat circuits on a board. They are building complex three-dimensional structures at the atomic level.
Wow.
So ALD involves depositing materials like hafnium oxide or titanium nitride, literally one atomic layer at a time onto a silicon wafer inside a vacuum chamber.
And doing that requires generating a highly controlled plasma environment, right?
Exactly.
Because if you want to lay down a completely uniform layer of atoms across a 300 millimeter wafer, the electrical power generating that plasma cannot fluctuate.
Not even for a millisecond.
Right. A microsecond voltage drop or a slight shift in the radio frequency delivery means the plasma density changes. The deposition becomes uneven and boom, a silicon wafer worth tens of thousands of dollars is completely ruined.
And that is the exact engineering bottleneck AEIS is solving for these foundries.
Which is why they have so much pricing power.
Exactly. They highlighted their Everest platform on the call, which is an RF power delivery system, and their EVOS platform, which provides direct drive plasma power.
And EVOS is specifically for etching, right?
Yes. The EVOS system is particularly critical for high aspect ratio etching.
Okay. Plain English translation time again. High aspect ratio etching.
Right, sorry. So that is when they need to carve microscopic trenches deep into the silicon without accidentally widening the top of the trench. It is like trying to dig a well that is a mile deep but only 3 feet wide, and you're doing it using electrically charged gas.
That sounds impossible.
The precision required for that is just immense. The plasma ions have to be accelerated in a perfectly straight trajectory down into the trench. If the power delivery is sloppy, the ions deflect, they hit the sidewalls of the trench, and you destroy the entire architecture of the microchip.
Oh, wow.
Yeah. So AEIS's direct drive technology allows the foundries to control the ion energy distributions with extreme fidelity. And the result for the customer is a higher yield, meaning way fewer defective chips and faster throughput.
And because they are solving that specific super high value problem, AEIS is fundamentally untethered from the broader semiconductor cycle.
That's a great point.
Right, because the overall wafer fabrication equipment market might be growing at one rate, but AEIS is actively stealing market share within that space.
Yeah, and we saw this play out on the call. During the Q&A portion, an analyst tried to correlate AEIS's 30% growth with the broader market's projected 40% growth.
And the CEO shut that down.
He did. He quickly corrected the premise, pointing out that AEIS has consistently outpaced the broader equipment market over the last 3 to 5 years by winning these specific high-complexity design contracts.
So they are insulating themselves by operating at the absolute bleeding edge of manufacturing difficulty.
Exactly. But the semiconductor segment, as robust as it is really only one half of the structural demand story here.
Right, because then we have the data center computing segment, the AI boom.
Yep. The data center segment generated $192 million, up 35% year over year.
There was a minor 1% sequential decline from the first quarter there.
There was, but the CFO really brushed that off as customers dealing with downstream constraints.
Meaning what?
Meaning the buyers had all the power supplies they needed from AEIs, but they were waiting on other components like cooling systems or specific networking cables before they could finish building out their server racks.
Oh, I see.
Yeah, so it's just a temporary logistical pause down the line, not a demand destruction event for AEIs.
The underlying driver here is the hyperscale cloud providers building out dedicated AI infrastructure.
Right. The power requirements for a server rack packed with AI accelerators are radically different from a traditional enterprise server rack.
But let me push back on this for a second, because I hear hyperscalers all the time.
Sure.
If AEIS is only selling to 4 massive companies, isn't that a huge concentration risk?
It's a fair question.
I mean, if you are entirely dependent on 4 tech giants, and one of them decides to alter its data center architecture, or decides to vertically integrate and build its own power supplies, AEIS takes a devastating financial hit.
And the management team addressed this exact dynamic on the call. They acknowledged that hyperscale clients are exceptionally engineering intensive.
Yeah.
They require highly customized solutions with super aggressive development timelines. Attempting to acquire every single hyperscaler as a client would actually fracture AEIS's engineering resources and degrade their profit margins.
So what's their play?
Instead, they are executing a strategy centered around what they term second-wave customers.
Second wave, meaning the Tier 2 cloud providers.
Exactly. Tier 2 cloud providers, large enterprise data centers, and specialized AI hosting facilities. They aren't the top 4 tech giants, but they still have massive capital deployment plans for artificial intelligence.
And the strategic brilliance of this second wave approach lies in R&D amortization, right?
Oh, totally.
Because AEIS has already expended the engineering capital to design these high-density power blocks for the primary hyperscalers.
Right, the hard work is done.
So they can take that core intellectual property, make some minor derivative modifications, and deploy it to the second wave market without having to reinvent the underlying physics.
It is the ultimate recycling of intellectual property, and the financial projection tied to this strategy is really highly consequential.
Give me the numbers.
The CEO stated that by 2028 or 2029, aggregate revenue from this second wave demographic is expected to match the revenue generated by their current largest hyperscale clients.
Wait, really? Match it.
Match it. So they're constructing a parallel revenue engine that inherently diversifies their customer concentration risk beautifully.
That's incredibly smart.
All right.
Okay, so AI and semiconductors dominate the balance sheet, but the transcript also details movement in their industrial and medical or I&M segment.
Right. Revenue here was $80 million. That is a 17% increase year over year.
And the I&M segment operates on a totally different cycle.
It does.
The CEO noted that quarterly bookings have essentially doubled compared to the sluggish environment of the past 2 years.
Yeah, and a really interesting leading indicator here is their digital pipeline.
How so?
They measure web inquiries that actually translate into real engineering design wins, and that metric is up 40%.
Wow, 40%.
Yeah, it indicates a broad-based recovery in capital expenditures across traditional industrial manufacturing.
In the medical space specifically, they highlighted huge traction in electrosurgery utilizing their pulse power technology.
Yeah.
We should definitely unpack the mechanics of that because it's fascinating. Electrosurgery isn't just about using electricity to cut tissue, right? It is really about managing thermal spread.
Exactly. Traditional constant current electrosurgical tools can cause collateral thermal damage to surrounding healthy cells.
Because the heat just spreads outward.
Right. When a surgeon uses a continuous electrical waveform to cut or coagulate tissue, heat radiates outward from the incision site. AEIS's high-voltage pulse generation technology solves this by delivering power in discrete microsecond bursts.
Oh, that makes sense.
Yeah, the energy is intense enough to vaporize the targeted cellular structure, but the brief off-cycle allows the tissue to dissipate heat before it damages the adjacent cells.
So the clinical outcomes improve drastically, recovery times shorten, and AEIS embeds its proprietary power technology into a highly regulated, high-margin medical device market.
We're switching costs for the manufacturer are astronomically high.
Oh, I bet.
I mean, once a medical device is FDA approved with a specific AEIS power supply inside it, the manufacturer is highly unlikely to redesign the whole device just to save a few dollars on a competitor's power unit.
It's just not worth the regulatory headache. And that same dynamic applies to their industrial automation and robotics contracts. They take commercial-grade power topologies and ruggedize them for harsh factory environments.
Now, rounding out the divisions, their telecom and networking segment generated $24 million, which is up 12% year over year.
Interestingly, management noted this growth was actually tied to those second-wave AI opportunities we talked about.
Wait, really? In telecom?
Yeah, telecom providers are evaluating rack power requirements for AI integration at the edge of their networks.
So the AI infrastructure build-out is bleeding into the telecommunications CapEx cycle as well. That's a great data point.
It's everywhere.
But to truly synthesize how AEIS is managing this multi-front demand surge, we have to talk about the inventory strategy, because this is a crucial plot twist in the transcript.
Yes, let's talk about the inventory. The CFO reported that inventory levels increased by 10 days, bringing their total to 145 days of inventory on hand.
Right, and that equates to an inventory turnover ratio of roughly 2.5 times per year.
Okay, hold on. For retail investors listening, seeing a hardware manufacturer stockpile 145 days of inventory usually sets off massive alarm bells.
Oh, absolutely.
It usually signals that end market demand has collapsed, finished goods are stacking up in warehouses, and the company is about to take a severe write-down on obsolete parts. So why is this actually a flex for AEIs?
It requires a paradigm shift in how we view supply chain psychology post-2020.
Right.
The CEO specifically used the term battle-tested. The semiconductor shortage during the COVID-19 pandemic traumatized procurement departments across the technology sector. Companies were unable to ship multi-million-dollar wafer fabrication machines or complete billion-dollar data centers because they were missing like a $2 voltage regulator.
The bullwhip effect in action. The downstream financial damage of a delayed component is exponential. If a hyperscaler is building a data center cluster and AEIs cannot deliver the power racks on time, the hyperscaler doesn't just lose the value of the power rack.
No, they lose the revenue from the compute time they were going to lease out. They have capital tied up in idle silicon, and their engineering teams are just paralyzed.
Consequently, the absolute worst operational failure AEIs could commit right now is becoming the bottleneck for a customer's product ramp.
Precisely. So they are deliberately absorbing a short-term hit to their working capital efficiency by hoarding strategic piece parts and electronic components.
They are eating a short-term hit to guarantee they capture that future revenue upside.
Right. And they are keeping staffing levels artificially high at their manufacturing facilities in the Philippines, Malaysia, and Mexico.
So they have basically abandoned the just-in-time manufacturing philosophy championed in the 1990s.
Totally abandoned it.
And replaced it with a just-in-case fortress strategy. They're tying up their own cash to guarantee supply chain continuity for their clients.
And the only reason they can execute this maneuver without angering their shareholders is because of that $1.4 billion cash war chest we discussed earlier.
Right.
They have the balance sheet liquidity to eat the carrying costs of 145 days of inventory.
Which transitions seamlessly into Section 3, management guidance.
The crystal ball.
Exactly. Because AEIS is building up components because they see a massive wave of demand on the horizon.
Right. You do not accumulate that volume of component inventory, and you do not deliberately suppress your working capital efficiency unless you possess absolute contractual visibility into a massive demand cycle over the next 12 to 18 months.
So let's look at exactly what management promised for the future. Looking at the Q3 2026 projections, they guided revenue to approximately $640 million, with a margin of error of $20 million.
That implies another significant sequential leap.
Yeah, and they're targeting non-GAAP EPS of $3 flat, based on 41 million shares outstanding.
But the more critical data points are the revisions to their full year 2026 metrics.
This is the really juicy part.
Because management teams are typically super conservative when revising full-year targets midway through the calendar.
Right, under promise, over deliver.
Exactly. But AEIs completely abandoned their previous modeling. They upgraded total full-year revenue growth from a low to mid 20% projection all the way up to a low to mid 30% projection.
Adding a full 10 percentage points to a top-line growth target for a multi-billion-dollar hardware operation. That is highly unusual.
It is. And the underlying composition of that growth is even more aggressive.
What are the specifics?
They raised the data center growth expectation from the mid 30% range to a staggering 50% or higher.
50% or higher?
Yes. The magnitude of that acceleration is just difficult to overstate. Their data center business had already doubled in 2025.
Right.
Now, off that newly doubled baseline, they are projecting another 50% expansion in a single year.
And the semiconductor segment is mirroring that velocity, right?
Yeah.
With second half growth projected to approach 50% year over year.
Yep. The margin profile is expected to scale concurrently, too. The CFO indicated gross margins should reach approximately 42% by Q4.
Which is incredible.
And they have a definitive pathway to exceed 43% in the long term as the product mix continues to lean toward those high premium Everest and Evo S platforms we talked about.
Furthermore, despite the inventory buildup and increased capital expenditures, they are projecting 2026 free cash flow to equal or even exceed 2025 levels.
Which brings us to the capital expenditure profile. That's the final piece of the guidance puzzle.
Yeah, let's look at CapEx.
They raised their 2026 CapEx target to a range of $180 million to $195 million.
Okay, and why the increase?
The primary driver for this elevated spending is the accelerated build-out of a new, large-scale manufacturing facility in Thailand.
Okay, the Thailand factory. This facility is arguably the most important physical asset on their roadmap right now.
Oh, without a doubt.
They expect this plant to begin generating its first production revenue in the fourth quarter of this year.
Right. They are currently running qualification protocols.
Meaning the major semiconductor and hyperscale customers are, auditing the facility to ensure the manufacturing standards meet their exact tolerances before they authorize mass production.
Exactly. And the CEO dropped a specific metric regarding this facility that warrants deep analysis.
The big number.
The big number. He stated that once the Thailand plant is fully operational, Advanced Energy will possess a global manufacturing network capable of generating $5 billion in annual revenue capacity.
$5 billion. Let's run the math on that statement for a second.
Let's do it.
Based on their Q3 guidance, their current annualized revenue run rate is roughly $2.5 to $2.7 billion.
Right.
So they are intentionally deploying hundreds of millions of dollars in capital to build a manufacturing footprint capable of producing double their current output.
Yeah, and you have to realize, a publicly traded hardware company does not build $2.5 billion of excess manufacturing capacity on speculation.
No way. The board of directors would never approve that capital outlay.
Never. So what this tells us is that the hyperscalers and the wafer fabrication giants have shared their multi-year capacity roadmaps with AEIs under strict non-disclosure agreements.
Oh, see.
AEIS calculated the future volume, realized their existing facilities in Malaysia, the Philippines, and Mexico would be completely overwhelmed, and broke ground in Thailand to meet the contractual demand they already know is coming.
That is such a strong signal. And it also serves as a geopolitical hedge, doesn't it?
Oh, absolutely. The technology sector is acutely aware of the supply chain vulnerabilities concentrated in China and Taiwan right now.
Yeah, everyone's nervous about it.
By standing up a massive, state-of-the-art facility in Thailand, AEIS provides its hyperscale customers with geographical diversification.
So if trade restrictions tighten or regional conflicts disrupt shipping lanes, AEIS can shift production loads across its Southeast Asian network to maintain delivery schedules.
Exactly. It's a massive competitive advantage.
Right. So we have analyzed the margin expansion, the underlying physics of the semiconductor demand, the R&D recycling in the data center market, and the aggressive capacity expansion in their guidance.
We've covered a lot of ground.
We have. So the objective now is to synthesize this data into a definitive position, which brings us to our fourth and final section, the bottom line.
Bullish or bearish?
Exactly. We've unpacked everything. So what is the actionable takeaway for you, the retail investor?
The opinionated stance here is extremely bullish.
Extremely bullish. Okay, let's break down the why for retail investors.
So AIS is basically a dual-engine growth story. It is a picks and shovels play on the two biggest trends in tech right now.
Right, the rising complexity of semiconductor manufacturing and the massive power requirements of AI data centers.
Exactly. Selecting the ultimate winners in the artificial intelligence software space is highly speculative.
Oh, for sure. We do not know which foundational models will dominate in 2030. We do not know which specific foundry will ultimately win the yield war at the 2-nanometer node.
But the laws of thermodynamics are non-negotiable.
I love that phrase.
It's true. Regardless of which logo is stamped on the outside of the server rack or the lithography machine, the internal components require precision power conversion. You don't have to bet on which AI software will win. You just bet on the fact that all of them will require highly specialized, insanely efficient power delivery.
So, for the actionable insight, if you are currently holding AEIs, the guidance, the margin expansion, the 0% debt financing, the $5 billion capacity footprint, it all indicates a prolonged runway of pricing power and volume growth well into 2027.
And if you are evaluating the stock for future allocation, there is a specific technological catalyst approaching that demands really close monitoring.
Yes. The transition to 800-volt architectures in data centers.
The 800-volt transition was a recurring theme during the analyst Q&A, and it represents a fundamental shift in electrical engineering at scale.
Okay, let's explain this simply. Currently, the standard data center infrastructure operates heavily on 12-volt or 48-volt power delivery, right?
Right, with cutting-edge facilities currently utilizing 400-volt systems.
But the physical limitation of those legacy voltages is just copper.
Yep. Electrical power is the product of voltage and current.
So if you need to deliver exponentially more power to a new cluster of AI GPUs, and you keep the voltage low, you have to push a massive amount of current through the system.
And high current requires incredibly thick, heavy, expensive copper cabling.
Not to mention the heat.
Exactly. Pushing high current through copper generates immense thermal friction. You lose a significant percentage of the electrical energy as raw heat before it ever even reaches the processor.
It is wildly inefficient.
So by upgrading the entire architecture to 800 volts, you double the voltage, which allows you to halve the current while delivering the exact same total power.
It is the equivalent of upgrading from a congested local highway system to a high-speed bullet train network. The energy travels faster with drastically less friction and heat loss.
Right. And the CEO noted that AES has already engineered modular 800-volt power solutions that operate at roughly 98% efficiency.
98%.
Yeah. They are currently in the evaluation phase with major customers with high volume production slated for 2028.
So the financial implication of the 800-volt transition is a massive increase in revenue content per rack for AEIS.
Because managing 800 volts of direct current in a dense server environment without causing arcing or, catastrophic failure, it requires a tier of engineering that legacy power supply manufacturers simply do not possess.
AEIS solves the harder physics problem, which allows them to capture a larger percentage of the total data center build cost.
Exactly.
Which brings us to the final structural question this entire analysis provokes.
Right.
I want to leave you, the listener, with this deep-cut idea to mull over.
Let's hear it.
We're witnessing an environment where AI clusters are transitioning to 800-volt architectures just to prevent the physical footprint of the data center from melting down under its own thermal density, right?
Right.
And the math required to manage power conversion at 98% efficiency at that scale is exceptionally difficult.
So the question is, will that vertical spike in engineering complexity create an insurmountable barrier to entry?
Precisely. Will this massive spike in complexity effectively price legacy commodity power suppliers out of the market entirely?
It's a real possibility. I mean, if a hyperscaler is deploying a $2 billion AI training cluster, the risk tolerance for a power supply failure is absolutely zero.
They cannot legally or financially afford to source commodity power equipment.
Right. So as the thermal and power density equations become exponentially harder to solve, does the market just naturally consolidate?
Does the sheer difficulty of the physics create a highly profitable monopoly for precision engineering firms like Advanced Energy?
If the industry reaches a state where only 2 or 3 firms globally have the intellectual property to safely power a next-generation AI data center, the valuation model for a company like AEIS completely transforms.
They cease to be a hardware vendor, and they
Yeah.
become a systemic utility for the digital economy.
The transition from providing a commodity to providing critical, irreplaceable infrastructure.
That is the thesis to track as these 800-volt systems move from evaluation into mass production in 2028.
A fascinating company to watch.
Absolutely. Thank you for joining us for this Talk Ticker-style deep dive into the corporate mechanics and physical realities driving the numbers.
We hope this synthesis of the data provided a clear, actionable perspective on the underlying forces shaping the market.
Remember to stay curious, keep diving deep into the data, and we will see you on the next deep dive.